Afternoon, everyone, and welcome to the latest FX webinar from NatWest. I'm Paul Robson. I look after FX strategy here at NatWest, and as usual, I have Piers Leslie alongside me. He needs no introduction, but he is the founder and chief strategist at Fact Not Fiction Forecasting. We'll be spending the next half an hour or so looking at what we think might be in the cards for major currencies for the next few quarters through 2026. As usual, I'll be going through the fundamental outlook, looking at macroeconomic themes, interest rates, how I think that they impact currencies, and Piers will be doing his technical analysis of the same markets. Certainly looking ahead to Piers' section, I think a lot of super interesting insights from Piers later, most obviously on the dollar. It's been one of our key focus for in terms of fundamental strategy, and I know that it's one of Piers' focus as well. So really looking forward to his update, how he sees things playing forward. With that, if we can just move to the first slide, please. So Piers is always telling me to move more quickly in my presentations and pretty much get on with it without too much introduction. So I decided to do something a little bit different this month. My first slide is what usually is my last slide in my presentations and webinars. It's the actual FX forecast that we currently have. In terms of the numbers, they're unchanged from the numbers and projections we were looking at late last year. I think you would have also heard from my colleague Brian Dangerfield, who looks after FX strategy from a US point of view. So I've highlighted the two forecasts that attract most attention from people we talk to liaising via NatWest. The sort of title of the slide gives it all away, really. The key message here is sterling dollar gains we think are possible, but as always, and I would stress this, that it's largely, we think, a dollar move, hence why I think what Piers has to say in a few moments about the dollar will be very interesting. So you can see that we've got sterling dollar rising up through 140. It's less aggressive than we had previously, but we've had a move up in sterling dollar already. It's happened a little bit more quickly than we expected, but we still think that the dollar underperforms against a broad range of currencies and ultimately goes through 140 up to 142. If you look to the second table, that's got the sterling forecast against the euro, and you can see we've got a relatively flat euro sterling outlook. That's actually the flattest forecast that I've had for sterling euro over the last 20 years being at NatWest, and I think that again it's really there to highlight that for major currencies we do think it remains a dollar world, and that continues to be our focus. It doesn't mean we can't get some volatility around that. I will talk about some of the risk points that we think, most obviously around politics. That's obviously been in sharper focus in recent weeks, and as we go through the year, I think that there'll be a persistent focus for markets, but ultimately we think that sterling euro looks relatively fair. The other two charts that are here show our forecasts for sterling dollar and sterling euro relative to what other people are thinking about currencies. So I think it's always useful to benchmark our outlook with the street. The top chart is sterling dollar. You can see that we're more sort of optimistic side of the consensus for sterling dollar. The sort of yellowy line, mustard line, is what the market expects. So they're thinking we stay around 135 for most of the year. There's some people that are pretty pessimistic, looking for sterling dollar down to 125, but we're on the top end of the consensus. The other chart shows euro sterling, and you can see that our forecasts are relatively flat, not too far away from the sort of average expectation of the street. There's some people that expect sterling to do significantly better, maybe looking at those highs that we saw in 2024. But equally, there's also some people that are pretty bearish. But the key takeaway from these two charts is maybe we have a more negative outlook for the dollar than the rest of the street. In terms of the dollar view, we think it's still a story of dollar debasement, de-dollarization, or simply just diversification away from US assets. And I'll go through that in a little bit more detail. Could I have the next slide, please? In terms of the forecast, zooming out for a moment, those forecasts that I've just shown have a number of underlying assumptions in them. We call them six. We've got 6 themes for the year ahead. You'll call, for people that managed to dial in at the end of last year, these 6 themes will be familiar. So I won't be going into a lot of detail, but we think that these are the things that will anchor currencies in 2026. So we've got monetary policy divergence. That's just saying that central banks are still moving in different directions. You've got places like the Bank of Japan that like to raise rates. You've got the US central bank likely to cut quite aggressively. Bank of England might cut a little bit more, ECB done, but you are getting some divergence because the growth. And we still think fiscal policy is still going to be a focus for markets. And I think this is at play really, where you're seeing it already this year for Japan. That's meant to be a big focus about the extent to which they loosen fiscal policy. Here in the UK, it's where the risks lie for the currency, whether people worry about debt sustainability. In the US, they're still running massive deficits. And the key here is that the rest of the world finances those deficits. And one of the crucial outlooks, drivers for the dollar, is to what extent international investors are still prepared to fund the deficits, and crucially at what levels and what rates. And I think that matters as well. Number 3 is Trump 2.2, the second term of Donald Trump and the second year of his second term. And to be honest, I think that just dominates the outlook and certainly the dollar. We'll look into that a little bit later. Other top themes for the year ahead, shifting global trade, that matters for currencies. I think manufacturing and strategic alignment. We've got this de-dollarization that I keep mentioning. We've got geopolitical developments. If I'm really honest, if I look at those 6 themes, I think all of them actually have their center on number 3, which is Trump 2.2, and that continues to move the needle on markets. Next slide, please. So this chart is just to highlight that we're still in a very uncertain world, and the outlook for 2026 is uncertain, but it feels like the events of this year will drive the events over the next, or themes over the next decade, really. So it does feel really quite important. And this chart, I think, highlights just how global these geopolitical events. So there's a mix of, unfortunately, wars on this, or conflicts on this slide, whether it's like Thailand and Cambodia, all the way to Congo and Rwanda. We've got Russia, Ukraine also. But it just plays to this these long-term themes for markets of shifting power bases, climate change, demographics, not just an aging population, but in some economies, bulging young populations, and you mix all that together, climate change, it's important, and the race for technology. So this is going to be a persistent theme. The one thing I would say here, though, is that markets have been relatively desensitized to all these events. But I get the feeling that it's very similar to putting straws on the back of a camel, and the saying about the final straw breaks the camel's back. And I think as we go through the year, there is a risk that we have raised volatility. But as I say, at the moment, markets have become, but you can see US tariff policy, foreign policy shifts pretty much impacting every part of the world, and the moves to multipolar world just place that idea. Next chart, please. So when we think about the dollar, I think one of the main drivers of the dollar in 2026 will be this idea that the policy outlook in the US is just shifting. And it's not just foreign policy or trade policy, it's domestic policy, it's immigration policy. It is pressure on the financial or the institutions of the US. And the most obvious one, I think, plays out via independence of the Fed. We now know that Walsh will be the head of the Fed, but there will be huge pressure, we think, for the US central bank to cut interest rates. And you can see from here, I've got how the policy rate in the US has evolved over time. Our forecast, which is the mustard coloured line, dotted line, and then with the market. So we do think that once Powell steps down in May, interest rates are cut. But even if they're not cut, we think that there'll be intense pressure on the Fed to cut interest rate, and then it will be changing mandates, oversights of the Fed. And I think this is something, the drama around this is something that can change the appetite of international investors to fund those twin deficits that I mentioned a little time before. So no change there, we think. Next slide, please. Just very quickly, I think people have seen this chart before, those that have dialed in before. It's just making this point about you don't need the dollar to lose its global reserve currency status for it to sort of go down. There's plenty of opportunity for reserve managers to hold different currencies in their reserves. And you can see that this is a multi-year theme. Reserves are massive. And any sense that reserve managers want to diversify will have, we think, an impact on the dollar. And then you've got hedging strategies that will matter. And then also just personal preferences to hold US assets if you continue to get the drama around policy, for example, Fed independence. Next slide, please. Just very quickly, just for UK macro update, Bank of England delivered a dovish hold last week. Feels like they'll still cut interest rates. A weakening labour market seems to be their main focus. It may come as early as March, but ultimately we don't change our long-held view that the easing cycle in the UK is almost finished, we think, at a relatively high level, which can, we think, support the currency to some extent. Next slide, please. Sterling has actually been performing relatively well on a sort of week-to-week, month-to-month basis. It's been a little bit more volatile in recent days, most obviously, we think, on perceptions of political uncertainty. But sterling has recovered since the November budget. The budget was, there was no obvious missteps in the budget. I think it was greeted pretty well by the parliamentary Labour Party, soothing market concerns about leadership change. Recently, worries have returned over fiscal policy and leadership change, but it just shows you But I think the outlook for sterling will be a function of politics, and related to this is fiscal policy. And when we think back to those 6 themes for the year ahead, fiscal policy, I think this is where it plays out. Next slide, please. And this is my last slide, and I'll be handing over to Piers in a moment. But I think for sterling, the fear is that politics remains uncertain. I'll leave it to others to talk about the reasons for the political uncertainty that seems to be ebbing and flowing recently in the UK. I won't mention anything regarding preferences in terms of politics. All I will say and refer to is past historic correlations. And what they show is that when markets have worried about leadership change, they have worried about fiscal policy, fiscal rules, debt sustainability, and the currency has fallen and bond markets have fallen. And there are some potential risk events on the horizon that could impact the currency. We have the by-election at the end of the month. We have the local elections in May. I don't think the spring statement at the beginning of March is going to be impactful on the currency. But I think when we think about that relatively flat outlook for sterling euro, I think this is the area that causes volatility periodically through the year. And with that, I'll hand over the call to Piers.
Thanks very much, Paul. Very interesting. A lot there. I hope I don't always ask you to go quicker. I bet go quick after you said that. So we'll go straight into the first slide. And that's the dollar index monthly chart. Now, this is a chart I had on last year. It's a long-term trend line since 2011. You know, we've seen it rally off that about 17 times. So it's sort of crucial line. And last month we had it on the webinar, and I was saying we were above the line last month. Price was rallying, but I was saying, look, the risk is if this line breaks. And if we go to the next slide, please, you'll see, this is it zoomed in at the end, that it has broken. Last month, it closed below that line. First monthly closed below the line. And another thing we know from technical analysis is that old support switches to resistance. So it's been quite interesting this month. That black dash trend line in the red circle has been the high. When the dollar index rallied back up after being below it where it opened, it hit it and people sold. So it tells you that at the moment, the pressure is on the downside. Now, I had an area before of resistance saying that if you wanted to see a stronger dollar playing out and you wanted the risk away from this trend line, you sort of needed the sort of 101, 102 area, those two orange lines across the chart. The reason for that was the old lows. So we know it's now switched to resistance. And you can see that in 2025, every time it went up to those lines, it failed and it came off. So that still stays the area that the dollar index needs to get above to show people are interested back in the dollar. There's a different level to show that the negative field is easing, is that trend line now. So that sort of comes in a sort of like an early warning system. If price starts to get above that trend line, why is it above that trend line? Something must have changed because people are happy to sell when the dollar hits that line. So where does that look for the downside? Well, we spoke about before, there's sort of an area around about 93.5 area where I see some support. And I've put that on the weekly charts. It's quite a good level on there. But if you look left on this chart, always look left on the charts, you'll see it was the old highs before this last run up higher at the beginning of the slide. So again, we talk about the rule of polarity. So as price gets down there, it should find some people interested in doing a sort of profit taking or buying just to sort of see what happens. But the really strong support as you come down here is in the 91, 92 area. So that's an area where there should be support. So now the risk is a move towards 93.5 see what happens there. Is there a bit of a bounce? If that area breaks, then maybe down towards the 91, 92, where I expect longer term support to come in. Again, we know that upside, if it starts to get above 98, 97, 90, 98 area, then we know the negative field eases a bit. So we need confirmation also on this break. It's quite a big break. You want to have, it depends on your conservativeness, because some people like to have 2 complete sessions under the trend line to be a true break. Some people go with 2 closes. So this month will be interesting to see if we get the first one of those, like another close below the trend line. That will give it more credence that it's not a false break and we're going back higher. But those are the levels that I think we should watch at the moment. And so we go to the next slide. We're now going to look at sterling dollar. Now, this is a very interesting slide for myself. We had this on last month's webinar. It worked well last year. This is just a very big level in sterling dollar. This sort of 137.88, 138 area. We've seen a move up there this year and it's backed out of there. We didn't get a weekly close up above there. So it's just an area to be mindful of on the big picture. It's held it since Brexit has happened is the word I'm looking for. Since Brexit, it's swapped from being the old support area for sort of 20, 30 years. It's now the resistance area for the last decade. So you can see that sort of at 138. You do have that pink moving line behind, which is at 144. That's a 20 period moving average. And so it's that 138, 144 area to watch on moves higher. But last month, I said, if we go to the next slide, we looked at the support levels. So I did the quarterly supports, and you can see we're going to do this quick because nothing's changed here. On a quarterly basis, the support for sterling dollar is sort of the 129.5, and the pink line underneath, that's about 128.5. So just below 130, we can see there was a good reaction off that 23.6 in the last quarter of last year. It bounced very quickly off there. So the impulsive uptrend is still intact, but the uptrend has a problem in that it's hitting that yellow cloud, that yellow shaded area, which is the Ichimoku cloud. So that's sort of stalling it, along with, you'll see 37.90. Where's that area? It's from the previous chart. It's that 37.88 area. So that's why price is just struggling when it gets up there. But at the moment, the attack higher is intact. The first area of weakness would be if you saw below 129.5 on a quarterly close. Right, and if we go to the next slide, please. This is the monthly chart. So if you go, well, I can't wait till the end of the quarter, got to know a bit sooner. Well, we can just look at the monthly chart downside levels using the rally of 2025. And so that has 133.76 as the 23.6. So any move below 133.76 on a monthly chart, and we'll keep you posted on these webinars, that would start to be a bit of concern. But it's not a real concern for the sterling dollar bulls unless you break below this 38.2 and 31.65. So that's 131.30, 131.60. That's the 38.2 20-period moving average. So it's below there. You'd start to think, are we going to be going for that 129.5 area on the quarterly chart? So at the moment, it's still in an uptrend. It's still making higher highs and lower lows since 2025, but we just need to keep an eye on that. How strong is that 137.80, 138 area resistance? Right, if we go to the next slide, please. This is what I said last month. Last month, because of time, I just did the downside and said, look, we'll look at the upside next time. So this is the quarterly candle. And what we're looking at here, you can see it a bit clearer here, how that Ichimoku cloud, that yellow shaded bit, price has hit there on 3 separate quarters and failed, sort of come off the cloud. And the cloud is also at the same level we know from the retracement. So it's just a bit of a struggle. So I think on the monthly chart, to start to get a look higher, I'd really like to see price with a sort of a close getting above 139.60, which suggests the quarterly chart is probably going to be breaking that 61.8% extension here in those two circles. So that's another reason, three reasons why it's struggling there. It's 61.8% extension, it's the 23.6 retracement on the other one, and the Ichimoku cloud. So I'd really like to see price through that. I just sort of see that 139.60 as a sort of resistance area on the monthly chart. Above that, and then I think you might start to see some move higher. So use that sort of 138, 139.5 as a 1.5% resistance on the top. Start to break through there, things are changing. Below there, they remain resistance. So if we go to the next slide, this is sterling euro. And this isn't updated. This is still the same chart that I put in from last month. And what we try and do on these monthly webinars is try and give you key levels to watch during the month as the month goes along. Now, I gave you a level last month and I said, look, you've closed below the 23.6 on the yearly candle. It's fallen off the 38.2 very nicely. It's always fallen off the 38.2% since Brexit. It goes there and the long-term sellers just come in. Because I think the problem is that for the long-term players who are international and everything and just sort of see sterling euro and just sort of, there's nothing's changed since Brexit for them. So it's the same sort of, we're out of Europe, nothing's changed. And you've just got that line going across that every time it gets there, that's there, we'll sell. So I said, watch out for 116.09 as the first retracement area. And on my system, it stopped at 116.11, which I don't think is too bad, 2 pips off. That's where sterling euro fell off. And I've just brought that back just to reiterate how to try and take the monthly webinar and use it in your day-to-day. So if we go to the next slide, this is also actually from November. And another point, I just thought I'd do this because I went to do the slide for this month on sterling euro and something just shouted out at me. That last year, this was the slide I used a lot during the year for sterling euro on the monthly webinars, saying, look, we have that Ichimoku cloud. So when you're below the Ichimoku cloud, it acts as resistance. When you're above the Ichimoku cloud, it acts as support. And I was saying that this is the slide from November, 19 times that had held sterling euro. And it was the first time I sort of turned positive on sterling euro last year and said, look, this 112.45, 113.05 should be a bounce area, should find support. The risk reward should change in there. And if we go to the next slide, it's nice to see that worked so well. You can see in the large last blue circle, that's 3 months where price went down and touched the very bottom, tried to break through, and it couldn't. And in the pink circle within that blue circle, you'll see that price spiked into that 112.45, 113 area and rallied out. So that was the switch, the risk reversal area I was talking about. Then if you look at the rally back up out of that, we're stopping at that sort of 116.08, 09 area or 116.10 area that we spoke about. So that's the first area of resistance. So since sort of November, sterling euro has been going up. It hit that resistance area and it was an immediate, it wasn't a, we have to think about this. It was just sell. So people were happy to take profit after a small move. The uptrend's still intact because you're still above the cloud of the bounce. This is the uptrend since November, still intact. Where does this uptrend need to break to get another leg higher? Well, we've seen that 116.10, but the 38.2 of the move down is at 116.54. So I'd say you need to sit above 116.5 on a monthly close to start looking for further gains. And if you do get above that 116.50, maybe you'll go up to the 118.5 area. But just at the moment, I'd just be wary that at 116, 116.5, that is resistance. That's what needs to break to go up. And we just need to watch on the moves back down, where is support. On the support side, I'll probably say about initial support should be about 114.10.20 area. And then it comes down to that 112.45, 113 area. That remains a key area as well. So the next slide we have is euro dollar. And euro dollar, we can see it's just like cable really. This move up, going up, it's pushing on up, trying to get higher, but it has some resistances to get through. And I'd say the 121.30 area is the next main resistance, because we can see the 61.8 at 119.28 has held it for some time. So the 121.30 area, I think if you want to see euro dollar higher, it needs to break that, and then you might go up towards sort of 125 area, 124.5, 125. And on the downside, I think that if you start to see a monthly close, we have to take the last one we have on here, which is the one before this. You can see there was a spike on the top, a spike on the bottom, and that's probably down at 116. So it needs to get below 116 to start to worry about how is this move with euro dollar going. Down below 116, it starts to become a worry. What's happened to the bullish sort of feel that euro dollar's had since it broke the Ichimoku cloud back in early 2025. Right then, that's it from me. The next slide is the most important, that I have to just say, this says everything I've said might be wrong, could be very wrong. So, and not to take it, that's a disclaimer. But with that, I'll hand it back to you, Paul.
Thank you very much for dialing in to this month's NatWest FX Monthly webinar. Thank you very much, Piers, for your contribution as ever. And we look forward to seeing everyone in a month's time. Thank you.